Hey everybody, welcome to our weekly Wednesday webcast. Today we're going to talk about how to get acquired. So by now, I'm sure you've read the news that Square has acquired Weebly. So I'm going to hit on three key points today. Number one, I want to talk about the growth story behind Weebly. Number two, I want to talk about the importance of culture fit when you're going to get acquired. And number three, last but not least, I want to talk about how to protect your equity. So Weebly is a very fascinating story. Back in 2006, three Penn State students saw this problem over and over and over again. They had one friend who was in an astronomy class and who had to create a website. She couldn't figure out how to do it. They had another friend who wanted to put his resume online and of course couldn't figure out how to do it. So after observing this problem, they figured out they would create a solution. So February 2006, they write their first line of code. Over the summer of 2006, they work all summer long working on this project. So by fall 2006, they can launch their private beta. Fast forward 2007, beginning of the year, they get into Y Combinator. May 2007, they get a $650,000 investment from Ron Conway. By 2008, they have 1 million users and they are profitable. Now, it's important to note that from 2009 on, this company remained profitable. That's not an easy task for a technology company. So let's fast forward to 2011. 2011, with only 13 employees, they get up to 7.5 million users and attracted about $10 million from Sequoia. So fast forward to 2014, they now have 300 employees, 20 million users, and attract $35 million from Sequoia and Tencent. At this time, the company is valued at $455 million. Fast forward to current year, 2018, the company now has 400 employees, 45 million users, and just got acquired by Square for $365 million. So wait a second. Didn't I just say that in 2014, the company was valued at $455 million and they just got acquired for $365 million? So if you've been around the weekly Wednesday webcast, you know exactly what that is. That is the dreaded down round. So of course, we'll come back to that. But for right now, I want to talk about the importance of culture fit. So Sarah Fryer, who is the CFO of Square, had noted that she was really impressed with Weebly and how they treated the customer. She felt that their values were really, really aligned. So let's take a look at what Weebly is all about. Of course, they have the standard stuff that most technology companies have, the free breakfast, the free lunch, the free dinner. They also have an in-house gym to work out in. They also have meditation classes, self-defense classes, and they even have pet therapy. And in fact, after one very, very stressful product launch, they brought in puppies and kittens to comfort their staff. So it is really an environment where they try to make their employees feel really relaxed and stress-free. They really make it a point to not hire any what they call a-holes. And in fact, they have a no a-hole policy. And what they do is everybody who comes to work at Weebly has 1 week of probation. And by the end of that week, they decide, are you an a-hole? Are you not an a-hole? And in fact, only 75% of the employees make it through their first week. So they do everything they can to make their current employees comfortable and make sure that no bad people get in. Now, if you're lucky enough to get through your 1 week and you're not an a-hole and you last for 5 years at Weebly, you actually get 6 weeks paid vacation and they will pay for your plane ticket anywhere around the world round trip. So it's definitely a nice place to work. And last but not least, they're all about diversity. And we hear this all the time, how important diversity is. Now, I believe diversity is important for the obvious reasons. It's important to include all different types of people. From a business perspective, it's important because if you are Weebly, your customer is the solo entrepreneur, the small business, and you're gonna find all different types of genders, social class, religions, races, backgrounds, belief systems within your customer. So it's so important to include everybody when you're hiring. So at Weebly, they have 50% female on their staff, and Square actually also has 50% female on their staff. The CEO of Square, Jack Dorsey, has come out and said that not only is half of his team female, 80% of his workforce reports up to these females who are leading the company. So it's definitely an inclusive environment. It's definitely an important environment. So these are important things to think about as you are scaling a company. What is the culture that you are building within your company? As you're bringing on your first co-founder, your first hires, what kind of values do they have? Because hopefully you're creating a company that looks like Weebly is going to attract a company like Square that believes in those same values. If you are going to get acquired, you're going to have generally payment up front and then what's called an earnout. So the payment could be like perhaps $100 million, and then the earnout could be perhaps $25 million. You have to earn that earnout. So if you are going into work with a horrible, horrible company and you can't stand the culture there, it's going to be really hard for you to get your earnout. So at the end of the day, it's not just a good idea to focus on culture. It's actually good for business to focus on your own culture and make sure that you're creating an environment that's really conducive to getting work done and creating a lot of harmony in the workplace, and also that you are looking to get acquired or merge with companies that share your values. Now, last but not least, David Rosenko, who's the CEO of Weebly, has come out and even said that he doesn't believe in this frenzied work pace that we all believe in Silicon Valley. He actually believes that when you work to that burnout state, you're actually less productive, which I absolutely agree with. So it's important to understand your value system and look for other companies that share that value system so you can have longevity after an acquisition. So let's go ahead and jump into that dreaded down run. I'm just dying to talk about this. So what actually happened? So Weebly gets acquired. The price was $365 million. 265 was split between cash and stock. 100 million was restricted stock units, RSUs. Sequoia ended up owning about 20% of the company. They went away with 91 million in stock and cash. And Sequoia put in about 35 million. So that's a pretty nice multiple. If you're in How to Win Over Investors, which is a free course that I put out, I kind of explain what investors look for when they're looking for a financial return. If you're not in that class, I will leave a link below. You should definitely check it out. So back to the story. So 365 million price, 265 was split cash and equity, 100 was split RSUs, restricted stock units, 91 million went to Sequoia, and then of course the employees hopefully had some. I don't know exactly how much equity the three co-founders had, but I will tell you this, the company was profitable, as I said earlier, since 2009, and they only raised about $50 million, and they were acquired for $365 million. So I'm gonna guess they had a pretty substantial part of that company. As I've said before on the weekly Wednesday webcast, the average amount of equity that the founder holds at exit is about 15%. So I'm gonna guess it was probably in the high 20s or 30s. So back to our story now about the dreaded down run and how you can protect yourself. So as we look at this next chart, this is a chart of anti-dilution. So the blue bar is our broad-based average, which is the gold standard of anti-dilution that you're typically going to see in a term sheet. The next bar, as you see underneath, that is full ratchet. The next one is narrow-based average, which isn't really important to you. The only important thing you have to know is that majority of deals have anti-dilution, and what this means is that the investor is protected and you're not. That purple bar that you see on the bottom is the deals that did not have anti-dilution. So there are very few deals that are going to have anti-dilution. In most deals that we see today, the investor is protected. So does it matter that the company sold for $365 million? Not so much. It only matters to the founders. So let's go ahead and look at this next chart. This next chart is going to show you the very beginning, Q2 2014, which is about the time period that Weebly did their Series C. If you recall earlier, I said that they raised $35 million and the valuation was $455 million. Now, what's interesting here is if we look at that red line, that's the Series C line, the average valuation was about $100 million, right? And even if we go up to the gray bar, which is our Series D, the average valuation is $200 million. And remember, Weebly's valuation was $455 million. So based on the data, I would say that I think the problem here with the Weebly deal is that the valuation for the Series C was way, way, way too high. And if you recall, back in 2014, 2015, that was really the beginning of the whole unicorn era, right? Everybody wanted to get to $1 billion valuation. So what I would say here is that if you're in this position and you're just starting a company, you're just building out, really, really, really focus on a moderate valuation with healthy terms. So in a perfect world, you would get a moderate valuation that you know you can sustain and you wouldn't have anti-dilution. So if you can get away with that, do that deal. You don't want a deal that's just a sky-high valuation that you can't sustain and the investors have anti-dilution so they're protected and then you get acquired or you IPO at a down round and then you're the one who actually gets diluted out of your company. So just to summarize, today we talked about how Weebly found this problem and how they created the solution and how they scaled this business and how they got profitable. I'm a big, big fan of customer revenue. So if you can get customer revenue, get customer revenue. It's the best kind of capital you can ever raise. And then next we talked about the importance of culture fit. We talked about how Weebly has built a very warm, productive environment, how they are using diversity, how they are attracting the company's Square to acquire them, because at the end of the day, nobody wants to merge or be acquired by a company that doesn't fit their culture. And it's important to note that if you look in the SEC documents, Square is actually calling this a merger, not an acquisition. So a lot of the news reports are calling it an acquisition, but in the books, it's actually a merger. And then last but not least, we talked about our dreaded down round. So if you want to protect yourself from this down round, make sure that when you are negotiating your term sheets that you actually have a moderate valuation with really, really healthy terms. If you can get rid of anti-dilution, that's going to help you. And again, a perfect deal would be a moderate valuation, no anti-dilution, and other terms which you can read about in the startup law video. I'll leave a link above my head. You can check that out later. But at the end of the day, you just want really healthy terms. So I will go ahead and end today. And if you guys have any questions at all about how to value your company, how to figure out your customer avatar, I will leave my email. It's super simple. It's just my first name, Lili, at financeforentrepreneurs.co. I will leave a link to how to win over investors if you want to check out Founders Masterclass, which is a course that we have that focuses on customer avatar, growth equation, growth model, how to build a financial model, how to value your company, how to look at your cap table, how to create an investor pitch deck, how to understand what investors want financial return wise, and how to find investors and how to pitch them. I will leave a link to that below. And of course, 30 days of mentoring happens 4 times per year, January 15th, March 15th, June 15th, and September 15th, and you can get on the wait list down below. And I look forward to seeing you guys back here next week. So goodbye for now.